Investors aren't too impressed with President Obama's latest call to reform the big banks, and neither, apparently, are the financial institutions themselves. Surprise, surprise. My next guest is Jill Hershey. She is Vice President for Government Affairs at the Financial Services Roundtable, which represents 100 of the largest financial institutions. Thank you for joining us on the program, Jill. Good to see you. Let's start with the fact that your group objects to the changes that Obama has proposed, saying that the plan would restrict lending and also increase risk, among other things. But you also say that you share the White House's goal of reforms to strengthen the financial system. So talk to us about what kind of specific changes your clients want to see.
Yes, well, thank you. And that's exactly right. We are committed, and we do share the mutual goal that the administration has to modernize the regulatory framework for our financial system. It's absolutely needed. We need to move forward and fill regulatory gaps that do exist, and as we're recovering in our fragile economy, that's absolutely necessary. And part of that is strengthening consumer protection, looking at systemic risk overall, and being able to look at how do we have an orderly wind down of financial institutions that, if they are in peril, that we can come together and look at them and they can be wind down in an orderly fashion. What specific changes, though, would you be proposing? Well, our industry has been thoughtful, a thought leader on this for about 3 to 4 years. And we have been working with legislators and the administration, calling for enhanced uniform national standards for consumer protection, calling for a heightened council of systemic regulators so you can look across the market at activities and practices to identify systemic risk, which wasn't necessarily available in the past. And we think that that's important that that availability be granted to regulators to look at and identify systemic risk.
Jill, Paul Volcker playing a big part in yesterday's announcement. He has a lot of credibility, and he's been saying for a long time that this kind of change that the president is proposing is needed. How do you overcome someone like Paul Volcker and his influence?
Well, certainly his voice, very highly regarded, is an important part of the debate. And what we're suggesting is that it will be, that now comes be part of the legislative context and debate in the Senate. The ideas that Mr. Volcker and the president talked about yesterday, limits on proprietary trading, hedge fund activity, and also a potential divestiture of large financial institutions and their breakdown, they weren't necessarily part of the robust conversation in the House bill. They will be in the Senate bill, and that's the appropriate legislative process and calculation that we need to go through, and we want to be part of that. We have been and will continue to be.
How worried are your clients about Obama's proposals in any form passing?
Well, again, we really have extended a hand both in the legislative process and with the administration. And, it all comes together to be part of regulatory modernization. And so, there's always a give and take and consensus that needs to be had. And so I think what we need to do is identify what were the factors. The Financial Inquiry Commission is doing just that with the public dialogue. What brought us to the economic crisis? How do we move forward? And then how do we modernize the system so we don't get there again? And that's what we're interested in doing.
Very quickly here, Barney Frank has talked about preferring a 3 to 5 year timeline for Obama's reforms. What do you see, or what do your clients want to see?
Well, I think that the House, having passed their bill last December, the Senate is moving forward in a time frame that works to recover for the American economy, whatever works best to give us an effective bill.
Okay, our thanks to Jill Hershey of the Financial Services Roundtable in Washington.